As attested by the Euro-US dollar exchange rate, the immediate risk that Europe faces from a loss of Russian gas imports is acute, with the recession essentially guaranteed if gas inventory cannot be raised further ahead of winter or the weather proves harsh. However, beyond 2023, the continued removal of Russian gas from Europe's energy mix offers considerable opportunity with respect to economic growth and industry's cost base, potentially setting up the region to outperform the US in the medium to long run. The reason this is the case is that the response of European authorities to the threat Russia poses has been to double down on its green transition, targeting a 45% renewable share for power generation by 2030, along with wide-ranging efficiency measures. The cumulative effect of these policies is expected to be a reduction in emissions of at least 55% by 2030. In terms of support for the economy, €210 billion are to be spent on new initiatives across the continent by 2027. Importantly, this spending can be fully funded through Recovery and Resilience Facility loans and grants, and, once the investment has been completed, is estimated by authorities to reduce Europe's Russian import bill for gas, oil and coal by €100 billion annually. That is an annual saving equivalent to half the total investment under REPowerEU to 2027, a very good return. Now, some of these savings will go to other foreign producers, particularly in the short term, as LNG cargoes replace Russian pipeline gas. But towards 2027 and on to 2030, hydrogen is targeted as a key energy source for the region, with 50% of the hydrogen consumed to come from within Europe's borders. A doubling of solar output to 27 and a fourfold increase to 2030 also has potential to materially reduce gas demand, particularly if the rollout of heat pumps and efficiency measures across the economy proves successful. The REPowerEU initiative therefore has three primary economic benefits: an increase in real investment from now until at least 2027, a much more stable and lower cost of energy for European businesses and households, and finally, a reduced drag on the trade balance from energy imports, both on a nominal and a real basis. While fear over the consequences of Russia's invasion of Ukraine for Europe's economic health and competitiveness have materially depressed confidence and the euro's value this year, as we move through 2023 and then run towards 2025 and 2027, under REPowerEU, the region's fundamentals are primed to strengthen rapidly in a highly visible manner. Importantly, not only should this new economic reality turn the tide for confidence in the region, but also has the capacity to incentivise private sector investment by business and households into the long run, with a pipeline of work necessary to push towards net zero in 2050, broad and deep across the region. If the ECB can bring down inflation quickly, with only marginal and temporary costs to the labour market, the private sector will be well placed and incentivised to expand. Clearly, European authorities believe that the government leading the way with investment materially increases the probability of a successful outcome. This is true both in terms of reducing the economy's toll on the environment, but also in setting up long-term growth in activity and real income. Together with Europe's advanced industry, it is also a good reason to anticipate sustained strength in the euro from its current depressed level. We'll see you next time.